Special Purpose Acquisition Companies, or SPACs, have helped propel Q1 M&A deals to their highest level since 1980, with 103 SPAC combinations announced since the start of the year. SPACs are listed shell companies which raise funds to acquire private companies with the intention of bringing them to the public market, thereby bypassing the traditional IPO route. One of the most recent beneficiaries of the SPAC frenzy is WeWork, which has agreed to a deal that values the firm at $9 billion, just a year and a half following its failed IPO. While the SEC has opened an investigation into the vehicles, writing to Wall Street banks requesting information on how they are managing the risks associated with the blank check vehicles, in the UK, the Lord Hill Review recommended liberalising listing rules for SPACs. In response, the FCA announced a consultation into the listing rules and related guidance in order to strengthen protections for SPAC investors. While some, such as CEO and founder of Aquis Exchange, Alistair Haynes, said SPACs represent an exciting new opportunity for the UK market, others, including AJ Bell investment director Russ Mould, urged investors to approach with caution. He said that while SPAC deals may be booming in the USA right now, fear of missing out is just about the worst possible reason for making any investment decision. Investment trusts proved their mettle this month as a special piece of analysis from Link Group Dividend Monitor found the fund model managed to increase its dividend payments 4.2% during 2020, despite companies across the globe struggling to maintain payouts. Link attributed the sector's success to £1.6 billion of reserves held back from the good years to support dividend payments during the crisis. 6 trusts have now achieved year-on-year dividend increases for more than 50 years, with City of London, Bankers and Alliance Trust top of the pack at 54 consecutive increases. 19 trusts now qualify for the AIC Dividend Heroes list, with Aberdeen Standard Equity Income the newest entrant, surpassing the 20-year milestone. Private equity trusts have seen their long-standing discounts to net asset value begin to narrow substantially, from a high of 51% in March 2020 to 13% in March 2021 as companies continue to publish data from Q4. Association of Investment Companies Head of Communications Nick Britton said private equity had attracted investors' interest for its exposure to a broad range of opportunities in sectors such as tech and healthcare. And a figurehead of the investment trust industry stepped down this month, as Ian Sayers, chief executive of the AIC, announced his time in the role would come to an end on the 31st of December, more than a decade after he took on the position. Once again, a study has found that there are more funds run by men called Dave than there are female fund managers in the UK asset management industry. Daves and Davids manage 68 funds compared with just 45 funds held by women, or 7.7% of UK domiciled funds, according to a study by Morningstar. The story is much the same across Europe, with just 12.8% of Italian funds, 18.1% of French funds, and 20.9% of Spanish funds run by women. Additionally, research by Freetrade found the gender pay gap also impacts the returns on investments possible for women, with the average male investor earning £15,337 more from their investments over the next 10 years than their female counterparts. Flexible working must be seen as reason neutral, according to Rosanna Burcheri and Gareth Miller of Artemis, who argued flexibility should be built into every job as standard, rather than being offered retrospectively, and employees should not have to justify their need for it. Reboot, an organisation dedicated to supporting positive racial dialogue in the asset management industry, has decommissioned the use of the acronym BAME in any of its communications, stating a desire to humanise the conversation on race and move from placing non-white individuals under a single homogenous umbrella. And BlackRock has hired a law firm to conduct an internal review into the culture of the firm after former employees at the world's largest asset manager shared their experience of sexual harassment and racial discrimination and gathered more than 10,000 signatures on a petition for BlackRock to address these issues. March saw 2 industry veterans announce their retirements, with co-manager of Scottish Mortgage James Anderson due to step down in April 2022, and Wise Funds founder Tony Yarrow calling time at the end of June 2021. Terry Smith has also acknowledged his career cannot last forever, and has suggested head of research Julian Robbins may prove to be his successor when the time comes, although he gave no indication as to when this may be. Royal London Asset Management and Arabesque Asset Management each appointed new CEOs over the month, with Hans Georgeson inheriting the RLAM role from Andrew Carter, while Herman Brill takes on the chief executive position at Arabesque. RLAM also saw the departure of Lorna Blythe, who has joined Aegon UK to develop the firm's investment proposition, with a particular focus on workplace and retail clients. HSBC Asset Management found its new head of ETF strategy at rival passive provider Invesco in the form of Dominic Clabby, while Lombard ODA Investment Managers hired Raj Dave to launch a special situation strategy in its 1798 Alternatives division. After 10 years, Helena Viñez Fiestas relinquishes her role as Global Head of Stewardship at BNP Paribas Asset Management to Michael Herskovich, and Anne Fairweather has joined Hargreaves Lansdown as its new Head of Government Affairs and Public Policy. And Helena Morrissey is set to step down from her board position at St James's Place to take up a non-executive director role at AJ Bell, with an eye on succeeding Les Platts as chair. March saw the market standard for ethical and sustainable gold accused of failing to prevent both human rights abuses and illicit gold from entering investments. Global Witness, as part of a compact of 5 civil society organisations, said investors cannot have confidence that LBMA accredited gold is free from human rights abuses due to serious shortcomings. LBMA responded, calling for a global effort to reduce gold's illegitimate sector. M&G announced plans to end investment in thermal coal globally by 2040, and also revealed it would give shareholders a say on its climate plans at its 2022 AGM, while Elgin, the UK's largest asset manager, pledged to link climate targets to its boardroom bonuses. A further 43 companies pledged to reduce greenhouse gas emissions by 2050, joining the Net Zero Asset Managers Initiative. This brings the total assets committed to net zero to $32 trillion, more than a third of global assets under management. The month was rounded off by Deliveroo's IPO, which left rather a bad taste in the mouth of its new shareholders as the company wipes off almost £2 billion from its valuation in the first day of trading. Asset managers had lined up to shun the public listing of the food delivery company, citing concerns around governance, with the dual-class share structure leaving CEO Will Shue with 57% of the voting rights. Other managers highlighted issues surrounding workers' rights of the company, which were thrust into the spotlight following a study by the Bureau of Investigative Journalism, which revealed that riders were often paid less than minimum wage.